on the glossary with this mix of letters not in order. For S, I'm telling you about seed, Series A, Series B, and all the other S's that follow. And so you've definitely heard about these before. Successive funding rounds in the startup life cycle, starting with seed in the early stages, obviously, and then increasing capital and valuations, move it to Series A, B, C, D, E, etc. So it's not uncommon right now to see pre-seed funding, and the accelerators I was just mentioning is a good example of it. I've even seen pre-seed, and so that's that. The scale keeps enlarging. Just know that that's the order, right? It starts with seed and whatever pre before it, and then goes A, B, C. Once upon a time, not that long ago actually, the first money a company would get would be A, and then the second money would be B. But then of course we got the system a bit more complicated with this B and B. And so, but just to highlight what it means. Another thing I wanted to highlight is that the dimension of what it means to be a seed or pre-seed or Series A round, it varies widely by sector and the specific needs of a company. So there's really I've seen seed rounds from 100 to 300K to 5 to 10 million, and that's a seed round. So a lot of it can be a lot of things. It will depend on your company. It will depend on the sector you're operating with. And if you're doing health, right? If it's a digital health company versus sort of more capital-intensive project in the therapy or diagnostic or medtech space, it may look very different. But this is in general one. One thing is for sure, it tends to go up, and the valuations tend to go up as well. So I just don't get too much sidetracked. I am putting H here for health because this is a little bit what our focus is. It's my focus as well for sure. Even though I do life sciences in general, and there might be some other biotechy projects I interact with, I tend to do health mostly. And so I just wanted to highlight that if a VC firm is doing health or is claiming to do health, that tends to require a high degree of specialization, and given the complexity of the projects. And so if you have a project in this area, you should try to match up with a VC that really knows about the sector and that can really give you that help. It tends to be further subdivided into areas such as therapeutics, medtech, diagnostics, digital health. They're fairly familiar with those. But we tend to put things in buckets just to sort of, because projects will have similarities about how they are run, and these are some buckets that we tend to use. This graph, I'm putting it here for two reasons. I don't agree too much with it, but I think it tells you not that much different from what I've been telling you, which is family, friends, angels at the beginning, and then a combination of plethora of many other investors that can come. I would say at any point, so I don't really understand why some of the things are restricted. It should be across the board for all of those, including venture capital funds, but other players. But also to use it, if you notice, I sort of copy and paste the previous graph into this one. So even though seed, Series A, etc., just means the order of the rounds, they tend to match with the development stage of different projects. And talking about therapeutics and pharma specifically, if you see the bottom, R&D, preclinical, phase 1, phase 2, phase 3 on the market sort of timeline, and I'm sure it's a timeline you're familiar with. In general, if we're talking pre-seed, we're talking a very early R&D idea and proven, and that's pre-seed should be happening around that stage. When the project moves to a more formal preclinical trial, that's normally what we mean by a seed stage in this area, and that money that takes from that is required from taking it from preclinical into the clinic for phase 1 clinical trials, that's normally where the Series A is at. And then whatever is needed for clinical trial Series B and onwards. There's a lot of exceptions to this rule. Again, this is not even a rule, but generally, if people are talking about a Series A, that's the moment in time that we're talking about. Again, full of exceptions, but it tends to be this that the market is sort of stabilizing in terms of window. Another thing I wanted to highlight that sort of goes with my first point, that you really need specialized VC behind you if you're doing a health project. Health can look very different from other venture capital projects in the sense that you'll spend most of the lifetime of the company dealing with the regulators and not really getting a product on the market, right? More likely than not, you'll probably never get a product on the market unless we're talking about digital health or something else. And so the fact that there are no revenues, that there's no sales, and all of that sort of frame of mind is not immediate to most of managers out there. So you really want to deal with someone that has already done this before, knows about the sector, knows about what's needed for the project, and sort of doesn't confuse you and that adds entropy to the project. So that's the importance of going with a VC that has a degree of specialization. Okay, so this is a little bit about what I wanted to tell you on sort of as an intro on what's venture capital and what are the other players out there at the beginning of the round. And let me tell you again, using the letters of the alphabet, a little bit about the process. So what do you need to be equipped with for your first interactions with VCs, and then some terms that they'll throw at you during the process of getting invested. So first one is actually, I'm actually cheating here. That's trying to figure out what to do with K, and I ended up with know-how. Just to highlight that the expertise of your team is really what venture capitalists are betting on. And so make sure you have the right people beside you. You're not supposed to know it all. You're probably supposed to know a lot about the tech that you're proposing. Normally, most of the founders that I see are very closely related with the tech that they've developed. And that's great. And you have to have a deep know-how about the tech that you're putting forward. But you also have to have know-how in other areas about what it takes to run a business and etc. There's no problem with it being the first time that you're doing it. A lot of people will eventually be first-time entrepreneurs at some point, right? But make sure you're surrounded with folks that have that sectoral experience that complement you. Right? So if you're not too sure about how to go about the regulatory framework of your product, make sure that some advisor or someone close to you in the team, internally even, to sort of keep that insight. And if you don't have it when you meet with a VC, if you don't have that person in hand, either be open to welcome the VC suggestion, or say, I've already thought that this profile is needed, I'm going to incorporate it like 1 year down the line because it makes sense. So be prepared and make sure that the VC knows that you're thinking about it. What you're trying to ultimately to convince the VC of is that you and your team are the best people in the world to do that project, because you have an intimate knowledge of the tech, because you've worked with it before, and because you're better positioned to take it forward. And that's ultimately where you're trying to convince your investor that to be the case. So I went with intellectual property or IP. I'm sure that this is something that you've been talking even in this course, so I won't go into too many details. You know what IP is, right? Broad description of the set of intangible assets that are owned or legally protected by the company. And so you know that in health, we're probably mostly talking about patents in a lot of the cases, but we're also dealing with trade secrets, and in all cases, pretty much a combination of the two, right? So if you have an algorithm, you don't want to patent it, you want to keep it as a trade secret because you don't want to publish the recipe for someone else to use without you knowing. And even if you have a compound or something, you don't really want to tell all the nitty-gritty of all the details about how you produce it, or you might want to get some trade secrets that's not necessarily published. And even if you've ever read a patent, you know that that's not a recipe. It's just a lot of things are perfected there, and they don't necessarily know exactly what within this patent you're going after. I'm mentioning it here because it tends to be crucial for you to provide some IP to VCs. If you're doing an initial round pre-seed idea, it kind of goes with the definition that the IP might not be fully established. But if you're going for the full-on preclinical trials from that on, if the VCs are investing millions of dollars or euros in your idea, they should have a degree of comfort that that's owned by you and that your company is the only one that can do it, and it's not, company B all of a sudden going to come up with the exact same product, and there's some degree of protection there. And so make sure that your project cannot be very easily replicated because you do have that IP space around it. So important, and really important, together with the team and the IP, the two things that I highlight in terms of interacting with the VCs, and even in early interactions, to give them a good sense and a good sense of confidence that you have the right people behind it and that you own what you're trying to do, and everything else is a measure of risk. And even these things are a measure of risk, right? But then everything else can fall into place. So if everything goes well, and if your initial interactions with the VC are successful, then they'll start talking about due diligence, or DD. So that's what VCs refer to as sort of going a deep dive into your company, into your project, and trying to learn everything there is about it. And so we're talking about the business plan, the financials, the team information, the patents, whatever it could be. Every piece of paper that you have attached to this project, you're eventually going to hand it over, and everyone's going to try to scrutinize and make sure everything checks out. It's not, it's not that we don't trust, even though there's famous examples of Theranos, if you know, read the book or watch the HBO documentary of Theranos if you're interested in what can happen if people don't do their due diligence. There's a degree of trust, of course, but if there's documents out there, it's out of our responsibility as VCs investing the LP's money to make sure that everything checks out and we're not just investing in thin air. The business equivalent of a full body scan, when you go to the airport, you also have to go through the scan. So that's a little bit about what it is. Not mistrusting necessarily, but you need to make sure that we're not taking unnecessary risks by not double checking all the information. So hand in hand with N, I went with non-disclosure agreement, or NDA, which is also very common lingo when interacting with the VC. So the NDA is an agreement issued by entrepreneurs to protect the privacy of their ideas when disclosing those ideas to third parties such as investors. And here I really want to highlight when to bring up the NDA and when does it make sense to do so. So if you're having your first meeting with a VC or even your second meeting and you already are mentioning an NDA, it might cause the VC to pause, right? So if you're just telling me about what you're doing in very simple terms and we're having an hour chat or a half an hour chat and you're already telling me about an NDA, then going back to IP, if you're just describing it in general, I'm not seeing the microstructure, there's nothing about that, and your idea might not be very well protected. Or even if it is, then you're not giving me that confidence. If you cannot tell me like, well, I'm looking and designing a drug after Alzheimer's and that's what it is, this is how it works. Actually, here's some data about how good it works. You don't even tell what the structure is, you don't even tell about what family of compounds it is, as an example. And even in other projects, like in digital health, right? If by just saying the idea, by showing what you're doing, people can very easily replicate it and take it away from you. VCs will already take a pause, right? And so very early NDAs probably do not make sense. But if you're doing due diligence, of course, if you're handing out all the data about it, then of course an NDA should be in place, right? So just figure out that timing. You should be able to tell your story without requiring a confidentiality agreement. Do measure that and don't bring it up too early. Otherwise, you might discourage the other part in terms of why am I signing this? And then VCs don't want to be overly bureaucratic. So if I'm signing a document, then I need to keep track about what's happening. And so if you're bringing additional mechanisms before the right timing, it might be counterproductive. Also an exception, if you are interacting with what could be a direct competitor, right? So it's a pharma company, telling you about their project, or even people that manufacture or develop things for you, then an NDA makes sense, right? It's the VCs that are probably more likely to take offense or sort of start thinking about what does it mean. And so sort of use it with caution. It's an important instrument, but use it with caution, because in the right context, if a VC is signing an NDA, if they're means that they're willing to move to due diligence, it might mean that unless the due diligence brings up something bad, you're in, basically. So if you use that strongly, and then an NDA actually has a good meaning behind it. So for T, I'm going with term sheet. So if all of this goes well and you sign the NDA, the due diligence is successful, then the next, and actually the first real piece of paper that you get from the VC is what's called a term sheet. It tends to be a non-binding agreement and basically sets forth the basic terms and conditions under which the investment will be made. And so it's a couple of pages of, it's not the full contract, but this is generally the gist of what we agreed on. It's simplified in relation to the final contract, but it can still be a pretty complex document. There's a lot of clauses that can be brought up there. But the idea really is that this is the points that we need to agree on and that we already agreed on, let's do it, and then let's move on to draft the contracts. So a term sheet, even though it's non-binding, if the VCs are putting pen to paper and there's a document, it means that we're moving forward. No one wants to put a term sheet and then have it be rejected or for some reason not moving forward. It may take a while to figure out contracts. I normally sign contracts that are 200 pages long, so you can imagine the contracts are complex. There's a lot of things that go into it. And so a term sheet being like 2 or 3 pages is really refreshing. As long as we agree, then we let the lawyers figure out everything. There's still things to negotiate, but the term sheet being in hand, it's not a done deal, but it's looking very, very, very good. There's few things that can happen during that contracting phase that don't make it go forward. So there's reasons to celebrate whenever the term sheet gets in. So I'm going with milestones, and I'm going to use these next slides to go over some things that are in that term sheet that you should be paying attention to, and some things you shouldn't be paying as much attention as you think you should. I'm going with milestones. Is a fairly easy one. I already mentioned in my intro, and I think it's a fairly obvious concept, but I'll go over it nonetheless. More often than not, when VCs invest, they don't give you all the lump sum we've agreed on at the beginning. We come up with a roadmap. The roadmap has objectives or milestones, and then we'll detail those based on achieving those objectives. Then other tranches of capital will be provided to you. And so that's basically what it means. The reason for doing that, instead of giving you the lump sum, and sometimes people are a little bit hesitating about the milestones, right? Because they're important. It's the way forward. But as you probably, if you've ever wrote in a grant or submitted a project, you know that most of the times the road is a little bit bumpy, and the roadmap and these milestones are going to change. But by giving us some exposure to it, the goal is for us to work together, right? The investor, the investee to work together. Okay, the roadmap is changing. The milestones do not look the same like they did where we invested, but we can adjust and work together towards them. And so it's a good mechanism to have some rapport and some relationship ongoing between the investor and the investee. Otherwise, here's the check. I'll see you in a year and a half. Come tell me what happened. That's not necessarily the relationship that most VCs want to have with their companies, and you probably don't want a VC that just gives you the money and doesn't give you no support during the process. So it helps establishing that relationship. So with P, I'm going with pre and post money valuation. So pre money and post money. This is really important. Founders tend to pay a lot of attention to their valuation, and I'm gonna hope in the next couple of slides to discourage you from just paying attention to it. It's important. I'm not saying it's not, but there's more things to it. And so, just going over the concept, so in case you're not familiar with this, the pre-money is the valuation of your company before the investment. The post-money is the valuation of the company after the investment. So the post-money is very easy to define. The post-money minus whatever has been invested in that round is the pre-money. The pre-money is the one more esoteric to define. So how much is your company valued when we invest? And so founders tend to pay a lot of attention to it. And I think Shark Tank and other things are to be blamed. Like if you've ever seen an episode of Shark Tank, the basics is the guy comes in, says like, I'm willing to sell 15% for 100K or whatever, and then someone will already say, okay, then you value me at this. Tell me about this. So very valuation centered, and it's a TV show. It's great. Just know that when an investor is investing, the value is merely indicative. It's absolutely theoretical, right? It doesn't reflect the actual value of the company necessarily, right? The actual value is whenever you sell the company and you make money. This is still very indicative. You need to make sure that the valuation is, of course, reasonable, and it's an important aspect of it, but don't only focus on it, right? Especially because if you start shooting to very high valuations in your initial rounds, and if you're dealing with angels or your family, they might even agree to, okay, I'm going to give you 50K, and you're going to give me 1%, but that, of course, translates to a valuation. Then when the venture capitalist comes in, it's an idea, everything is improvement. Why would I be, investing at the same rate? So, the subsequent capital needs tend to go up in valuation. So if there's weird things happening before, there's nothing that cannot be fixed. But don't always shoot just for the high valuation. VCs care about valuation, of course, and don't let anyone tell you otherwise. But there's a lot of other mechanisms and things that we can do to give you the valuation that you want. You think that you want the negotiation, but then we introduce a lot of other clauses that basically mean that the valuation there is on paper is meaningless. And that's because the valuation, it's just that, it's on paper. It doesn't really mean much more. More on that in a couple of slides. C, I'm using it for cap table. They tell me, Wikipedia told me that it really means capitalization table, even though I've never heard anyone refer to it as the capitalization table. It's the cap table. And so this sounds, I don't think it even sounds fancy. It's just a table of that gives sort of Mr. X founder X% of the capital, Mr. Y founder Y% of the capital, Mr. VC1 Z% of the capital. So really the distribution of who's the owner of the company in which percentage. Of course, there's always caveats, right? So let me try to go with some of those. The cap table, of course, gets more and more complex as time goes by and more capital comes into it. And the sort of most important distinction there is to distinguish common versus preferred stock. So common stock, as it means, is like base common stock, but then you have preferred stock. And I'm already hinting to some of the things that I mentioned before. So VCs, when they invest, their stock will have some preferred clauses. So their stock has some mechanisms. One very common mechanism that is instituted is actually sort of business standard. Is that VCs may have veto power. So even though they only hold 20-30% of the capital, some sort of minority stake, they in certain aspects of the company they might have veto power. And so that doesn't reflect their ownership of the company, but there's some sort of preferred rights that they have, and that will be reflected on the preferred stock. So keeping an eye of what's common and what's preferred. And just to mention that VCs tend to take a minority stake in the company, definitely for earlier stages. No VC company. So Portugal Ventures has over 100 portfolio companies. We don't want to own each company. We want to be a partner for the ride. We want to help you, but we want you to make us money, right? That's how it goes. You're making money for yourself, and we're getting some benefit in the process. But we don't looking to own the company. So VCs start to get nervous wherever it's close to 50%. I don't know. We don't want to be even on the running the risk of the baby falling in our hearts, and then we have to deal with the company that is ours, right? So 20-30%, somewhere there tends to be a reference, right? It gets a little more complicated if there's a syndicate, but and one thing is also for sure for early stage investing, no investor will take a Series A or later capital if the founders don't have a juicy, significant stake in the company. Right? So those are mechanisms to prevent the VCs from getting too greedy. I'm generalizing here. Of course, there might be some other predatory finance operators, but normally we're looking at a healthy minority stake, 20-30%. It of course depends on the specifics of the project. And here it says a little bit, a graph telling you pre-money, post-money, what happens to the investment. We'll go over the option pool. So L for liquidation preference. So this goes together with the two previous slides. These are the most technical terms I'm going to introduce, but I think they're relevant. You might not be as familiar with these, but so bear with me for a second, because this really goes together with a good example of why you shouldn't just be looking at valuation, actually looking at the other things in the term sheet. So the liquidation preference, as definition, is the order in which investors or debt holders get paid in the event of the company being acquired, or if things are not going that well, the sale of the assets resulting from bankruptcy. So as a rule of thumb, the last investor, so the last invested money, so the last people that put money into the company are the first to get their money out, right? So that's how it goes. So the last investor is the first one to recoup their gains, and it goes, et cetera, et cetera. And then the common shares, which unfortunately will be the founder's share, are sort of at the bottom of the stack. So after the VCs get all their returns, then whatever is left goes to the common shares. What VCs can do, for example, is that, okay, I'm going to give you the valuation that you want. But then I'm going to have a liquidation preference clause that by the end, you're going to give me 5 times or 2 times my investment. So only after the VC gets 2 times their investment can everything else flow and all the money. So you're actually getting the valuation that you wanted. On paper is only buying X% for that amount of money. But then is saying that, oh, in the end, I'm gonna be not only the first one to get back my capital, but I'm gonna get at least 2x out of it. And it's all great if the company is a great success and everyone makes a lot of money. Awesome. But if it doesn't go that great, if the sale is a little bit below, etc., it basically means that investor gets everything there is to be made out of the sale of the company, and you end up getting nada. So this is an example of a clause that goes into the term sheet, and that's why I wanted to use that sort of. I'm not saying it trumps valuation; it's another piece of the puzzle, right? But that can be used to really counteract counteract all the effort that you put on the valuation negotiation, and then all of a sudden there's other clauses that sort of prevent you from getting access to the real estate there. I'm not going to go into details about liquidation preference. There's a lot of that you can read about it. There's a participating, non-participating, and then the amount of multiple that can be there. Just pay attention to it and make sure that you're not trading off the valuation that you want from a very predatory liquidation preference if that's the case. So for option pool, and that's the last thing I'm going to tell you about the term sheet and things to pay attention to, or at least things to think of when the investment is happening. The option pool is a number of shares that it was shown before in the cap table that tend to be awarded to employees, advisors, or directors to both attract new talent and keep the talent that you already have. And so it's basically a reserve of shares that you give out to employees and to everyone that collaborates with the company to keep them motivated and aligned in the goals of the company. If the company is a success, they'll actually also get the benefit because they'll become shareholders. So these options, which is basically the ability to buy shares at a preset price that will be very low, vest over time. So just because I'm telling you about the lingo, let me tell you about vesting just for a second. Vest just basically means that the shares will be dispersed slowly over time as you stay with the company, right? And so instead of getting everything that is awarded to you at the beginning, the longer you stay with the company, the more you'll get, which incentivizes people to stay in the company. And it's a real great tool to, startups don't really tend to pay a lot, or at least not very competitive salaries compared to big corporations because there's not a lot of money floating around. And this is a good instrument to keep everyone motivated in the line and wanting to stay in the company and wanting to partake in the success of the company because in the end, they'll also get remunerated. And so the term sheet will also, in the cap table, will also reserve all these shares that also impact valuation, right? If part of the shares are going to be reserved for employees, that also has an impact. And so the term sheet will also define how many shares should stay for employee compensation. Okay, so I think this was the most technical things that I wanted to mention. I think it's important that you know how to read a term sheet. I'm hoping that you didn't go into detail in this course about it and that I was able to contribute something. But let me just ease off. I don't have too much time. I wanted to keep it to wrap up so we can have some discussion. But let me just go over some concepts about the day-to-day relationship between the VC and the startup company. So I went with quarter. It was also a little bit made up. It's not the most important VC definition, and you know what a quarter is. It's just 3 months out of the year. I just wanted to highlight here two things. The VCs will keep track of what's happening with their companies. I've already mentioned that. And both the VCs and the companies will likely have quarterly objectives to achieve, and it goes with the milestones and it goes with everything. So sort of reporting and keeping a close track of the financial report that is issued each quarter. Another thing I wanted to tell you is that as a rule of thumb, everyone tends to be busier towards the end of the quarter. So right now we're ending Q4, and we're actually also ending the second semester of 2020, and we're actually ending 2020. So as you can imagine, for a VC, there's a lot of things that I need to make sure happen before the 31st because they still report to this year, not to next year. But that generally tends to be true for every quarter, at least for every semester. So if you're starting a brand new relationship with a VC, catch them in January or catch them right after summer break. That's where they'll be sort of done with the past and ready to embrace new projects. So January tends to be the best. The year is already closed, but they're already still ongoing some bureaucracy, but they're full on ready to take on the year. After the summer break, it would be the other, depending which country or what time the summer break happens, in either July or August or September, what would be the best moment to re-engage them. But that is also when everyone comes fresh and looking for new ideas. And so that's just a hint. That's why I wanted to talk about the quarters for a second. B, board of directors. So that would be the group of individuals that represent the shareholders in the company, right? The governing body. I'm sure you know what the board of directors is. Anyway, I just wanted to tell you that normally it's a combination of the founders, the investors, and more often than not, an independent board member that might act as a chair, just to sort of balance the interests of the founders and the VCs and make sure that the project is propelled forward. There will be executive and non-executive directors, right? The executive ones are the ones that actually manage the project from day to day, whereas the VC appointed director would be a non-executive director. And so that's the structure of the ultimate governing body of the, not the ultimate, as a shareholders meeting, but at least the most interventive every day, every month, hopefully, or every 2 months, board to meet and to sort of oversee what's going on, strategize about the future, not really paying too much attention about the details. Sometimes we have to, but more on the strategy and where we should go and what should be the priorities for the next quarter, for example. So if for many reasons that I won't detail, VCs might prefer to appoint a board observer or might actually be reserved that spot instead of a real seat. The board observer is just someone that participates in the meetings but doesn't have a voting right. If it's a small company, it tends to be pretty much the same as being a board member because hardly there's any formal votes. In bigger companies, we will have different meetings. And so board of directors are the same for startups or big banks and big corporations, but what would be different is the size, right? A startup normally has 3 to 5 directors in the board, just to make sure that everyone is there. And so what are the board of directors talking about? We're talking about things such as runway, R. And it's a very simple concept, is the amount of time that you have in your startup before you run out of cash. And so it means a lot for healthcare startups, as I mentioned, there's not necessarily revenues when you're coming up with a new drug, right? So the only money you have is the one that VCs gave you, and which means that eventually it will come to an end, and you need to make sure that you're not running like that dude from Startup Air. You're not living on the edge, and that you're giving yourself ample time to either fundraise more, ask your current investors for more, to not come up with at the last minute, at the last month. Oh, by the way, I ran out of cash. So runway is very important for that, and specifically in healthcare startups, again, because they don't have this steady stream of revenue. J, I went with joint venture. So joint venture is just one of many sort of partnerships you can establish with other companies, right? I just wanted to mention that it can be very beneficial for a startup because it's lacking in resources and it's lacking in sort of dimension to partner with a bigger company, and that's not very well appreciated. That would be called a joint venture. I guess a good example of a joint venture that has been in the news a lot lately is the Pfizer BioNTech joint venture. Pfizer, a big mammoth, BioNTech, a smaller company. They put a product together out there as a joint venture, big success, first vaccine approved, etc. And if it's done right, it might lead Pfizer to just buy BioNTech. I'm not sure what they're about to, or even if that's how realistic that is. But that's an example of why it could be very important for you to partner with a bigger company and put your name out there. And not all joint ventures go as mediatic as the Pfizer BioNTech one, as you can imagine. But it's a good way to sort of introduce yourself to a potential acquirer. So you unicorn, I'm sure you've heard about this. This is like as media hype as it gets. You know what a unicorn is, hopefully. It's a privately held startup with valued over $1 billion. And the keyword here is privately, right? So public companies are not unicorns. They could be unicorns and then become public. And so I just went and looked for the latest stats. As of December 2020, there are more than 500 unicorns globally. And now there's other not so mythological creatures out there, 20 plus decacorns, which are over $10 billion. And there's one ectocorn over $100 billion, which is ByteDance, the owners of TikTok in China. There's been a lot of talk about TikTok. That's probably why it's still a private company, not a public company like all the other tech giants. But just giving you that I needed to use you for something, so that was clearly the most obvious. Just telling you that achieving a high valuation whilst you're a private company is not a goal in itself. It's good for media hype for you to be a unicorn, but it doesn't really mean anything. What you want to do is a little bit like Rhino, our buddy over there, is make sure that you're bringing and adding value to the company at every possible step. Not all ideas are worth 1 billion. You can still make a lot of money without getting there. Probably most of the single assets in terms of pharma are not necessarily getting there. Some of them do. But yeah, so your goal shouldn't be to be a unicorn. Your goal should be to all the decisions and everything that you make in the company day to day is bringing value, and then you're extracting as much value as you can. And you could dream of being a unicorn, but just do the work, and the success will come. Okay, and then just three, I think, more slides, just to tell you how does this relationship end. So what happens at the end of the VC startup relationship? So that, by definition, is what we call exit. So VCs will talk about exits a lot, and sometimes when they first meet you, so what's the exit strategy? How do I get out? And so exit, by definition, is a sale or exchange of a significant amount of company ownership for whatever it could be. And so the idea of VC funds really is to invest in companies with a clear short-term exit target in mind. And so if you're not contemplating selling the company within a few years, VC funding is not for you. Few years can mean different things for different investors, but if you have a business model where you'll grow and become, the next biggest company out there and you own it through the whole time, it's not a match for VC. We're looking for 5-7 years down the line to sell our share in the company. That's the exit strategy. It's most commonly achieved through M&A or mergers and acquisitions. We'll go over the details about what M&A means, but there's a cartoon over there to help you. They're basically the same thing, just the size of the company is different, but when it comes to the actual reality of the operation is very similar. That's why M&A is normally what's taken. We're looking normally at acquisitions by bigger players, but mergers can also be interesting. But they can also take other forms, and that's my two next slides. So an exit can go with Z0, and it's the emergency exit signs over there. And 0 is the absence of all magnitude of quantity. That's the definition. Not a VC one, it's actually the definition. And so, VCs is high-risk business, right? And so it's likely that we won't be able to recoup our investment. And in the end, we don't get anything back, right? And so that's not being able to get anything back or only partially get some money is a possibility that we contemplate at all times, right? And it really is the result of the high-risk business. And that's why VCs invest as a portfolio. So the idea is that if we invest in 100 companies, 5 will be super successful, 20 will be somewhat successful, and then by those successes, we'll pay everything else and all the investment that we did, right? And so that's the reality. That's the reality of it, and so we are prepared for it. I just wanted to let you know that this is something that we, of course, contemplate. We try to minimize it. No one wants to do an investment, and if he's thinking that it's not going to be successful, but it's a possibility. Or, I guess on the flip side, if you don't go 0, you can go Wall Street. So Wall Street, of course, is a street in Lower Manhattan in New York City. But figuratively, it's what I was going for here. It's the most advanced financial markets in the world, right? The U.S. financial markets. And so a very, very attractive exit proposition is what's called an IPO, or initial public offering. It's basically a process where you just list your company or sort of become traded in a public exchange. And doesn't need to happen on the U.S. jurisdiction. It often does because that's the most sort of sophisticated and advanced market. There's other stock exchanges. Portugal has its own. Spain and Italy, I'm sure have them as well. Not as dynamic. In Europe, neither of those. So I'm not criticizing anyone individually. In Europe, if we're looking at a biotech listing, we're probably looking at the Nordics. They have some Nasdaq there that is some dynamic towards biotech. Otherwise, we're looking at the US, and that's the reality of it. And so basically, what it means is that there is a lot of cash infused into the company when it goes public, and then VCs have that luxury of then owning shares that they can trade in the markets, right? So they can trade it all that day, trade it all that week. It becomes more of an investment banking sort of thing, right? Whenever it goes up, ticks down, and then we can slowly take our shares out of the market and recoup our investment. So that's a very interesting proposition. So exit, M&As more often, and then hopefully the exceptions would be 0. And in reality, the exceptions are also Wall Street, but it's sort of what the VC is looking at an aim. Definitely not 0, but a successful M&A or a successful public offering. So this brings me to X. I couldn't, for the life of me, come up with something that made sense in the VC world for X, so I went to the most obvious one, which is Christmas, to wish you a Merry Christmas. Hopefully, my message here was simpler than Jason's card to his dad, Peter, over there, and that you actually got most of what I try to tell you. And with that, I'm more than happy to take any questions you may have.
Thanks a lot, Raul, for the interesting presentation. Very dynamic with the letters and all the sketches. This ho ho ho. I hope it will be done with all our masks. Yeah, H2O that you have there, so it's important to be protected. I have some questions where I would like to give the floor to students for them to ask directly what they want. I know what they want. They want money. For sure, they are interested in bring you some doubts, some questions regarding what to do. What should they do? What are the roadblocks, the strengths that you see in teams, etc. So, students, do you want to raise some questions or comments? Or the other teacher, of course, Pia?
I have a question.
Okay.
Okay. First of all, thank you very much, Raul, for your presentation. It was really good, and a lot. You gave us a lot of important information about your strategy in investment. My question is about how has changed your investment strategy in this particular year, because we know that this is not a common year, and I think also your strategy probably has changed.
Yeah, no, that's a good question. I alluded to it when I mentioned pre-pandemic and post-pandemic, and let's see what the data tells us. But yeah, so Portugal Ventures specifically, I didn't go into details, but we have many different verticals we pursue, one of them being travel tech or tourism. So as you can imagine, that part of the portfolio had some significant impact this year because there was virtually none, and so they were, some of them were very creative about what they did, but of course it was more stress there. And so for us personally, what we decided to do this year, somewhere around March, was to sort of pause new investments, refocus on our current portfolio, make sure that everyone was sort of taken care of and spoken for, instead of prioritizing new investments for the year. We still made relevant investments this year that ended up being new as sort of the restrictions were lifted throughout the year, and I think we ended up investing more this year than we did last year. Again, some of it was focused on the portfolio, but overall in the numbers we ended up doing a good healthy amount of investment. But that was our decision. A lot of other VC firms, regardless of sector, decided to pause, see what was going on, and then sort of make their bets. It didn't take them too long. The good news is, if you're here, probably more likely than not, you have a health-related project, and it's a lot of people just decided, because nothing else was very working and everything else had a lot of uncertainties, to sort of put their money in whatever other things and put it in health. So there were a lot of big new funds being created, new generations of funds being created this year in health. A lot of movement, and so all the expectation is that the record from last year and this upward trend in investment in health and biotech is gonna keep on going. And so it is a good time, and the pandemic might have helped more people see. Who knew how a vaccine or what phase 1 clinical trials were last year? Us, right? Not a lot of other people knew. Now everyone knows what a clinical trial. Now they're convinced that it only takes a couple of months, which is even worse. But there's more people, so more LPs, more people ready to say, like, well, why weren't you investing in sort of preventive therapeutics before? Let's do that. And, it opened everyone's eyes to sort of the health field. They might be temporary. VCs are terrible when it comes to something being fashionable. So if something is fashionable, everyone wants to invest in it. It tends to happen with a lot of buzzwords, right? So if it's AI, everyone wants to invest in AI. If it's cell therapy, everyone wants to invest in cell therapy, and then they sort of ride that wave until something else new comes up, and so they go in waves and in fashion. Right? So health seems to be something that is attracting people, not only because the data has been looking good and trending good, but now because they see it as one of the few areas of the economy that actually grew significantly during 2020. So it seems to be a good moment. Let's see what actually ends up happening. It could be a hype and then it doesn't materialize as much, but it's looking good from my perspective.
Thank you very much.
Okay, guys.
So I have a question. Hello, Raul. Thank you very much for the presentation. It was wonderful. Some of the terms that you said we already talked about, but highlighting them in a venture capital way, it's very interesting. Nonetheless, as a young entrepreneur, I'm going to ask a question for my point of interest. I'm a young student, okay, so as well. So, as a venture capitalist, how do you guys help the transition of students who want to open their own startups from the early stage and have to have some help with financing to structure their projects and to learn more about the various fields of development to achieve the success of the project?
Yeah, so I didn't go over too much detail about it, but you're kind of asking me about my day-to-day life, or at least that's what I'm going to tell you. So in my area, what I tend to do is be in close contact with all the tech transfer offices and all the universities, all the institutes, so that I know where new technologies are sort of coming up, and then talking with the potential entrepreneurs and the potential people behind them, sort of as a courtship, relationship that we established before we eventually decided to sort of invest or not, right? So that's very typical. Different areas will do it differently. If my colleagues in what we call the digital team did that with everyone that came knocking on the door with an idea, they probably wouldn't have time to do their actual work. But at least I can still afford that luxury of being in close contact with most of those projects. And so that's something that we do. It doesn't mean that I'm helping passively, actively, it all depends, but I guess the negotiation of making an investment happen will come with different conversations that we'll have. Like, so they'll probably come to me, you pitch your idea, say like, this is great, but I would like to see more on this aspect, and then we'll talk a month later and we talk more about that aspect, but now I'm interested in seeing something else. And it's sort of this relationship that we build, and my feedback to you that sort of establishes until I run out of excuses, right? Until your project is perfect, it answers everything that I mentioned, and so we should be good to go. And it's always more dynamic when we build it sort of together. Even though you're doing most of the work, I'm giving my input, but let's call it together. I just want to say, if it's more like day-to-day help, really being about it, then the incubators, accelerators, and everything else, and all the other members of the ecosystem are more relevant. But yeah, but I would say that in general, we are available with the time that we have. I have portfolio companies, I have other things, but to meet with very, very young projects. And I'm not talking about your age necessarily, but young projects in general that can be coming from different walks of the academic life, which is mostly what I see, but from other areas as well. So yeah.
Okay, thank you. Because when you're starting, it's curious because you have access to more projects of financing with more money than less money to help you start. So you have to have a big project to go to the big money. But there are very few projects or very few available financing opportunities of less money for an early project. That's why I'm asking. And my second question was related to that, as how may I contact you later on to discuss the project and all? What's the better way for contact you guys?
So let me revise my first answer then. Now that you've clarified a little bit more, we do have a pre-seed program. It gives tickets between 50 to 100K. We're just about to announce soon, I think, the results of the first round of this program, and the second round of the program should go live next trimester. Don't quote me, I'm not managing it, but it's tickets between 50 and 100K. I don't know if it's a lot of money. For me, it's a little, but it all depends. Between 50 and 100. For projects that are just getting getting started, and so some they don't even need to be a registered company yet, so it's money for your registered company.
Okay.
So we do have a pre-seed program. It's called Call Innov ID, which is words on the situation this year, and this should go live the second phase of that soon. So we do have formal programs on that as well, and I tend to agree with you. There should be more opportunities for pre-seed funding. Everyone should have a place in the ecosystem. We're trying to position ourselves in a good slice of it. We cannot be responsible for everything, and we're not afraid to invest when a company is being created right out of academia with a patent, not much more. So we do that. It would be great to have more and more programs, and there are. Most of them tend to be formed with competitions. If you're here, probably EIT Health, and everything that they do is also going to be relevant. There's a lot of things out there. It tends not to be, then, you know, what I'm saying, tends not to be a lot of money. So like a 5K award there, etc. But it all helps, and it gives you a little bit of exposure. How do you get in touch with me? Just email me or add me on LinkedIn and message.
Okay.
That was the easy one. There was a second question.
Thank you very much, Raul.
No, my pleasure.
Raul, I would also like to raise you a question regarding IP, as you mentioned in your presentation. What is the most interesting stage of the IP strategy, of the IP implementation of the startup in these fields, like pharma field or biotech field? What is the most interesting stage of the IP of the startups for gaining the interest of investors in the sector?
Yeah, it's a tricky one, right? Because I might contradict slightly what I just told you in the slide. So one thing that you know, but I think everyone knows, but in pharma, once you submit the patent, the clock starts ticking, right? All of a sudden, you're under a time pressure. It might not look like a time pressure because there's many years, but it is a time pressure. And so VCs will want a patent to be submitted, everything to be done, etc. But they wouldn't be necessarily opposed to talk to you if the patent is already written, the lawyer already has it, but they haven't clicked send yet. Because, you know, then we have the luxury of time to talk about it, and etc. Assuming that what you're doing is not very time sensitive, or there's a high likelihood of someone else coming up. In general, I would say that, you know, the PCT phases or the initial phases of where the patent is still not public would be the ideal moment to engage with VCs. Some other
after filing.
After filing in general, yeah. So that year or so that you have, well, it's not necessarily public knowledge, so you can share with the VC specifically. You feel that you bring him to this exclusive club because you're one of the first ones to see it, etc. That might have some success. And so I would still say the initial moments. Of course, then it depends on the specificities of the project itself, how much that clock is really important. But if we're talking about pharma, we know it's going to take a lot. If we're doing it from Portugal, it's going to take longer. I'm using Portugal as an example. Spain is way more advanced, and we hope to get there soon, and Italy as well. But if we're doing it from Portugal, then we know we need to add 5 years, and hopefully not that much, but we need to add some years to it just because of the lag in terms of our ecosystem. So the sooner the better.
Okay. You also mentioned around the part of the term sheets. You mentioned the valuation of the portfolio of the startup. What sort of methodology do you use, or how do you value the IP or the value of the proposition that is in front of you?
Yeah. So formally, I don't know if you went into details in the course about this, formally, how can you evaluate what's the worth of an asset? What you do is something, you calculate the net predicted value. So basically, very simply, you think about the product being in the market, you think about the patient population for that product, you think about how much you're going to charge, and that's going to be in 20, 30, whatever. And then you bring that back to today and see how much that will be worth, right? So that's what that doesn't. Oh, it can factor in, but you know, just that number doesn't factor in. Is that likelihood of you getting from point A to point Z at the end is what it is, right? So it's not a black and white. There's a lot of gray there. There's a lot of things that it is black and white, right? You either get there or you don't, and amongst each step, there's a chance that it won't work, or preclinical, or the clinical, etc. So that value in itself is meaningless because it only has meaning if you get there. Then you need to factor all the risk, and there's only like an 80% chance to get there, 90% chance, 50% chance to get there. And so it's great. It's great as an exercise. It's great to know. It's great to have that data. But in the end, all of those things are indicative, right? And so the valuation to some extent is also indicative. And I did tell you, which is already a hint, that VC is looking to get a 20 to 30% stake, sometimes 40, etc. We tend to do investments around 1.5, 1 million, something like that. And so if we take that stake and this is the amount, and this is all more or less constant, the valuation will be around the same region of at least the same order of magnitude, right? And it doesn't go much further than that. So valuation is a piece. It's important. It can be, some things can be valued, especially if there are multiple positions or the likelihood of the project succeeding. So definitely in pharma there's there. In digital health, if you have initial users or something, there's things you can also do there in terms of metrics and initial sales that you can think about how really that much is worth. So you have other mechanisms. And then another sort of all-encompassing mechanism that is used is transactions that happen in this space in the last year. So if you're doing an oncology company and you have one asset in this specific cancer in the last 10 years, what happened to this company? And so you have a sense of what the market is paying for them, so you also have a sense more of the real value. But so it's a combination of all these methodologies that give you a sense. But in the end, the order of magnitude should, at least for us and for everyone else, has similar thinking with their numbers. It tends to be. It's not the most important piece of information for diligence because we know it's speculative.
Anyone wants to raise a question?
Yeah, I have another question.
Yeah.
Okay, which is related to the people in this time. Which are the main characteristics that, in your opinion, should have a founder of a company?
Yeah. Well, no one is perfect, right? So that's. I guess I'm still to encounter the perfect embodiment that does everything that that sort of can do everything, has that deep tech knowledge, but has that deep, can really pitch the project beautifully and can also do all of these other things. But there's multiple aspects to what sort of multiple dimensions that you can think of, right? So it is that technology being. We're talking about initial startups, so I'm always going to refer to you in relation to that. Later on, it might be a little bit different, but because there's not going to be a lot of people in that startup, I wanted someone to be very comfortable with the tech. I want someone that can also present to the public, also that can interact with investors, if they don't finance great, if they manage to trade, etc. So it becomes a checklist that is basically impossible for one single individual to be good. To have great relationships with other investors, with relationships with pharma, it's just it's an utopia. And so realizing that there's no perfect person, then what we're looking at is sort of the characteristics, right? Is this someone that is easy to work with? Is someone that is willing to learn and willing to accept new ideas? All these other things. In the end, that's the basis. So a lot of our investments end up being with someone that is related to the project, because I do a lot of lab-based investments, right? Drugs, therapies, etc. This will be someone that is related with the project, postdoc in the lab, or someone not necessarily a PI. The guy already has his career and he wants to go to university and run a research group, and it's great. They may be a chief scientific office. But it could be someone else in the lab that has that youth about their attitudes. They want to do it. They want to take the risk. They have that ability, and they're willing to run throughout the process. They can be a more experienced or seasoned manager that sort of identified some asset that are interested in the academic world and partnered up, and then there's two, or there's three, or there's four, and they all sort of complement each other. So that's a couple of things where there's no one dimension that I would value over the other. There's more sort of like no-goes. If they're complicated people, it seems like they're too into their own ego. People that are it's one of the things that people are sort of married, and they're both founders of the same startup. Then you're investing not only in the startup but also in their marriage, which the statistics is not great. So it's certain things. It doesn't mean that, again, if the two founders happen to be married, that's a no-go. Then we'll evaluate. So all of these things are but then it only needs to happen once that you have a bad experience with something like that you started double thinking a bunch of this criteria. So there are some no-goes. So in the end, what we want is what we call coachable leaders, so that bring a lot to the table, but are willing to learn and to adapt. We don't need necessarily know-it-alls and people that really know how to do everything, because those people don't exist necessarily. Like management level, at least in Portugal, we don't see a lot of those coming back. And even if they've done a startup before, they tend to move on to consulting to pharma, etc. So they want to do it again. In the US, it's a little bit more sophisticated. You normally have your CEOs for 6 days, your CEOs for Series A, and sort of recycle and stay in their wheelhouse. In Portugal, that doesn't necessarily happen. So we need to compromise over and learn that each individual is different. Just be approachable, be nice, be well liked, I guess, in the ecosystem as well. I don't know if I helped a lot because I just wondered in my answer. Don't be difficult. That's
Okay.
that's the bare minimum.
That's a cool recommendation. So I have the last question. In your opinion, which are the technology trends that should be monitored for the future?
Yeah, well, again, VCs go in passion, right? And so we can tell about some of the things that are already here and the ones right next that we can already see that they're trending in other markets that are probably going to be trending. But instead of that, I'm going to give you the honest answer. So a bit more, hopefully some decades down the line, but not that many decades, and 2020 hasn't helped. So I invest mostly in therapeutics, right? So therapies and drugs and other forms of therapy. And I'm of the firm belief that that it's not that shouldn't be a priority. Of course, it still needs to be a priority, but that in an ideal world, we'll move away from therapies because we'll be so good at diagnostics and so good at preventive approaches that the therapies will sort of run obsolete. So this is a little bit out there, but that's sort of the trend that I wanted to tell you. So if you can early diagnose pretty much anything, or if you can prevent pretty much anything, then there's no need to choose, right? In absolute terms. I know I'm living again in an utopia here, but that's sort of the overall trend. And so people have been with some reservations to invest in diagnostics because they only want to invest in diagnostics if there's a very immediate therapeutic consequence to it. So what does it matter if I know this person has dengue? There's no treatment available for dengue. I don't need to have a dengue diagnostic. Doesn't change anything in the clinical protocol. But if you can diagnose, and if you can early diagnose, it's like cancer, everything to do with liquid biopsies and etc. So that's been trending right now. You might now then encounter what could be called early treatment, right? So it will still be therapies, but very early, before the thing is a problem. How can we go about it? How can we prevent neurodegeneration? How can we go about it from the very early signs and symptoms of something showing? And then prevention, right? Vaccines and etc. How can you even come up with solutions for that? And so what I reckon is that we do have the technology to early diagnose pretty much anything. If we know how Alzheimer's might be an exception because not a lot of people know exactly what's going on. There's some exceptions, but there's a lot of hints that people can already put together in the big data world. Again, current trends. So early diagnosis within our tech available, our tech arsenal. Prevention for a lot of things, yes. For others, not yet. But the prevention is within our tech arsenal. So our more payer models make sense. So it costs you a lot of money to prevent something from everyone. It costs you a lot of money to diagnose everyone. But the value should be there to shift everything towards that and not go into therapies in terms of bettering human health. So all of those, and again, disclaimer, I do therapeutics. So all of those, I think, would be trends that not only you can already see through the things that are being invested these days, but I think will become more and more relevant as we're trying to tackle human health through prevention and early diagnosis, and not as much focus on therapies. And then digital health sort of encompasses all of this. Whatever digital health means, it can mean a lot of different things, but not only the patient being more connected with the doctor, patients being more connected with themselves, clinical trials optimization, whatever you can think in the digital world in terms of the big data and everything that you can also do with it. I think it's only going to add to this process of sort of making us worry about our health, not post-diagnosis what we're going to do about it. So let's have a seamless diagnosis. One good example is the blood analysis of diligence blood draws, which is a fairly recent thing to be done in the scale of time over humanity, and it's still a fairly simple blood panel. It does a lot of things, but it's still fairly simple. There's a lot of tech that can tell a lot, that can go way more further, without necessarily going all the way to genotyping. But there's a lot of things you can do with that information, and if you have enough information of that, there's a lot of things you can infer. So even that act alone, for example, I think is going to improve substantially in the next couple of years, which will radically change how we think about therapies. Sorry if I went a little bit above on the what you above and beyond what you're asking, but that's what I think will be relevant in the next decades or so.
Okay, thank you.
Okay, so I also would like to ask you something else. As humans, we expect to have also always some examples, some cases, and so on. Can you share with us a good and a bad one, like a success story that you have encountered in your investment management profession, and also one that went really well, really bad?
I'm sorry, can I interfere now? I think
Sure.
that would be an awesome question, Hal's last question. So, because I have another one, because I have not that interesting question, I would like
I'm
to
going to
put
take
my
Sophia's
first.
one because
Yeah.
I need to think a little bit further on Dina's question. So Sophia,
Okay.
please go ahead.
Okay. Possibly the bad ones can be related with your, I don't know, but your question, I don't know. It's just a thought.
No, I think my question is just too boring, but anyway,
Oh.
I want to ask him because he's on the loop on that, so I need to take some advantage of his knowledge. And I hope you all students, you all took some advantage from everything he taught us here today. So I will summarize this very quickly. When a project gets to you, what are the main issues that you immediately say, this project has to enter this? If it's not entering, I'm not spending my time on watching it. And the other question is, how do you help, for example, if you have an European company, a Portuguese company that needs to interact in a licensing process, do you help on that process, or you are just like aside because of your share of your equity? And in terms of exit, perhaps this is too much. Do you have any kind of exit strategy? How does that work? And then you can just answer, Dina, and we finish. Otherwise, you'll be too tired from us.
No, that's fine. So
Thank you.
exit, IP, and the priorities, and then share some horror story. Okay. And a good story as well. So let me go with exit first. So our exit strategy is dependent on the project, right? So again, I already hinted M&A, probably most of what we're looking at. So that's what we tend to gear towards. Definitely not geared towards zero, not necessarily geared towards IPO. It's going to be the exception out of something specifically, the ones that start in Portugal. Not saying anything hasn't happened before, definitely not happening in Portugal. And so that's normally the one we tend to, M&A is what we're going to prioritize. And the strategy there is make sure that at the right moment, at the right time, we use our contacts to make sure that our projects are that could be relevant. These are processes that take a very long time for the big players. Sometimes it's way better for everyone involved to look at medium players than necessarily the big ones. Big ones have too much internal. There are many times that in the medium companies than necessarily. So it can just be too cumbersome. And so there are a lot of other medium players out there, sort of pharma companies, biotech, for instance, right now could be a medium player right there acquiring new technology. So usually companies that just did their IPO or some of the companies that are looking to acquire new technology sort of engrossing their pipeline, these are also great targets as well. So not only just thinking about Novartis, Merck, but also think about the medium players that actually may be more active in the market and have capital to spend. So also another criteria, right? To try to figure out who could be a good M&A partner. IP? How much are we involved in the process? I would say that we are not. That's something that we tend to like it all being figured out before we invest. That being said, because we work a little bit across the Portuguese ecosystem, we sort of know what should be there, what shouldn't be there, etc. So we're more than happy to help you, assuming that we're already thinking of investing in the company that would be the output of the spin-off of that university, etc., right? To sort of help you with the licensing terms of what that should look like and make sure that, the royalties make sense, all the aspects of it make sense, and they're sort of on par without us breaking confidentiality, of course, but they're on par with what we see in the market, at least the local market. There's essentially three components to it, right, to IP licensing, which is the royalties, the milestone payments, if there are any, and something that has nothing to do with IP, but if the institute or whatever wants to get into the cap table of the project, right? Those are the three big ones that in general. Royalties, okay, they need to be reasonable, right? They're pushed on to commercial stage. We don't tend to worry too much about that. Milestone payments or being in the cap table of the company, that's something that we take a closer look, right? There cannot be a lot of milestones at the early stages of the process, otherwise we're investing and it goes back to the IP producer. The value doesn't stay where it needs to stay, right? So milestones should be pushed towards where the project can actually have the capacity to pay. I know it's nerve-wracking for leverage licensing, but in the meantime, if we're paying too high of a rent to the academic institution that originated at IP, it can be counterproductive. And then the entry in the cap table, it's another aspect to consider. And so it needs to be reasonable across these different dimensions to make sure that you're not asking for everything at the maximum at the same time, but there's a good mix of the different. Then priorities when looking at the companies. I need to confess that I opened a cheat sheet here, so I don't go through. I think there's 9 of them that I'd like to mention. This was on a previous presentation, and I took the slide out because I wanted to do the alphabet thing. So, but I went back to it. And so the first one I actually talked about, which is a team, right? So who's behind it? Are the right people promoting the project? So that's a key one. And then there's 2 that. It amazes me how still relevant they are, which is the problem solution fit. Is the problem you're trying to tackle a problem? Sometimes it isn't. Sometimes you have the tech and you came up with a problem because it works well to submit a grant, but it's not really that much of a problem, or it's not the best problem you could be tackling with your solution. And then again, is the proposed solution the best way of addressing the problem you're proposing, right? So is there that problem solution fit? Then again, can your technology, knowing about it, it's sort of a given if we're talking that there needs to be some tech behind it, right? Can you deliver the solution you're proposing, and do you own it, right? To IP, can you really deliver the solution you're promising? Then a little bit on the business model as well. It may be more or less relevant depending on the project, but are the customers interested in buying, and can they afford it? That's relevant, right? In health, it tends to not be as important, but it can be important for some business models, right? Then market. There's no secret that VCs want the market or the quantitative amount of money at pool that is there to be big. Normally 1 billion at least, right? It's not that easy, it's not that difficult to get there because you start adding a lot of things and it gets there. But if you're doing something that is for research use only, or that doesn't really impact health in general, or rare diseases, there's a lot of value that can be extracted. So it's not even necessarily the number of patients. Really is the market to be big enough for us to decide to take a risk. If you're just selling an instrument for labs to use in research, that probably is not very attractive for venture capital, at least not for us. And then obviously, is what's the competition going to look like? Is there a real incremental advance compared to the current landscape? Are you really bringing it up in a notch? Is this like something new? And then one that I think it's important, I didn't talk too much about it today, but one that I think is really important because it goes back to my answer to Gonzalo earlier. So what are the main challenges of this project, and how does our investment work to ameliorate them, right? So how can we help? Are we just giving money? What else can we do? How can we establish a relationship, learn about the risks, and even take some risks before the project gets going? But then when the project gets going, do we know where the gaps are at? and can we be better ready with our investment to do it, right? So are they addressable? Is there something we can do about it? And is our investment directly going to it? Because in the end, most, if not all of our investment is going towards de-risking, the thing that we use a lot as well. It will sort of de-risking. So as an early investor, what you want is de-risk the most that you can, so the investor that's coming next doesn't feel that risk perception, right? And so what we're about, and the whole bringing value to the company is all about the risk. Having less uncertainty and more certainty as much as you can in the project that it's built. And so the risk factor is very important to it. And then one that we just alluded to, when and how does the project end? Does it have an end? Some business models do not have an end, but how can we exit from it? And so that's also a question that it's good to come up with at the beginning. You know, a lot of people establish a company because they say, okay, I have this idea now, and I have this drug and this patent, and I'm going to use this company to bring value to it. And then, you know, then I'll come up with other ideas, and I'll do, you know, other rounds of, and I'll use the same company to sort of just create a mini pharma company. Which is a great business model, nothing against it, but it doesn't really give the space for us to lead, right? If you're gonna develop a product and already have another at the same time, and etc., and they're all different in different classes, and you're thinking that that's gonna be your life from then on, to sort of run that company, and that's what you're gonna do with a sort of small pharma company. I'm talking about the and Antonio was here earlier. They've grown to be big. But that is not very conducive to venture capital. So investing in Bial when Bial was smaller, 100 years plus ago, right, would not necessarily be for VC because there would be no exit. Because the company is still there, we would still have a stake in it, and we'd not have to recoup the money for our investors. And so it's nothing against the business model, it's just not a match for venture capital. Okay, so I think, Sophia, if I did okay enough, I answered most of your questions. Okay, great. Thumbs up.
Perfect.
And now I need to go back to Dina, and because I was worried about Sophia's question, I didn't. Okay, so
just tell us about a best practice, a story to tell.
No, I can tell you.
Something that will enlighten our startuppers here.
There's some confidentiality, of course, to certain things, but you know, there's a lot of lessons learned, and you know, I've personally been doing it for 2 years, but the team altogether in health, we've been doing it formally since 2013, 14. But you know, in other sectors, the team in Portugal Ventures traces back to the late 80s, and so there's a lot of lessons learned inside the company in terms of how to do things and how to do. And then there's all the nuggets are sort of different for the different projects. So what's the success and the best practice? The thing is, like, I think I've already went through most of the things I wanted to tell you. So that joint venture figure, let me revisit that. So that way of sort of bringing the pharma company or wherever you want, the potential partner that is going to acquire you close at a good moment in time when you have confidence enough about your tech, but you really need some more resources behind it. It's a great instrument. And not just because Pfizer BioNTech makes it easier for me to just mention it casually. It does. It definitely helped me in terms of talking about it in public. But that, whatever shape that could be of, that's great because the big pharma are increasingly relying on external innovation and not just the internal pipeline. So that's a trend that we can see as well. So they want to actually actively do things outside. And so they're interested, you're definitely interested, to just find the right time, find the right in, and see if there's something that you can do without putting you in jeopardy, right? You don't want to go to a pharma company like, here's everything that I have, buy it for a couple of euros, and then we're done. So of course there needs to be some tact, it needs to be tactical. And so yeah, just bringing that as a success because there's hopefully soon we'll be able to make a public announcement of one of those sort of partnerships in one of my portfolio companies. It's not public yet, but it's something that, of course, brings things with excitement. Okay. On the flip side, I think I would use the same example because this is a very frustrating process. Especially if you're talking with big pharma, it takes. It's an amount of time that is more measured in years than in months. So it's more than a year, tends to be. It takes a lot of time to align all the pieces, to talk to all the relevant folks, to make sure that they're comfortable in taking a risk, even to just create a joint venture. Not even talk. So it's not, to some extent, it's not that much different from an exit, which also takes a lot of time. And here is something that is very important because it has, that I'm using it as a bad example because it has happened before as well. I'm keeping it general, but big corporations have all the time in the world. And all the time in the world. They don't have any rush. Especially in med tech. In pharma is a little bit different because I told you about all the medium players and they can have very, very active. But in medical devices, there's like 4 or 5 big players, and it's all going to end up with them. So they don't need to be in a rush. And so they take whatever time they want. They talk to you, then they pause, then they go up. And a startup does not normally have time. We saw the runway plane right very close to the edge. A startup has everything but time. Everything is for yesterday. We need to move as fast as we can. And so that clash when you're trying to get those two structures to sort of arrange something is terrible. Because a startup cannot sound desperate, right? If we really need to sign this tomorrow, like, oh yeah, but then you're running into trouble. I don't want to talk to you again. So you cannot sound desperate, but yeah, you have to adjust to their timing and sort of apply some pressure. It can be very frustrating. I mean, there's years that can go like up and down. I think everything is going great. We're going to close this month, and then no, it's not. And then it's very emotionally complicated to sort of manage that process as well. So if VCs are complicated towards getting investment, way more agile than what comes after when you're trying to look at a joint venture.
It's like a roller coaster. So
it's like a roller coaster.
Yeah. So guys, I think that we have finished with Raul Saraiva for the moment.
I took you way more time than what I thought I would. So
because we need to learn from you. We need to have different perspectives, and it is of extreme importance for people like us. I'm involved, of course, I'm included, in finding more and knowing more of the strategies to raise funds. So, Raul, thanks a lot for your time, for your availability, for the availability that I know for sure you will have for our students here and for all of us. In my name and Sophia here as teachers of the module, thanks a lot. Have a Merry Christmas, in safe, in health with your family, and thanks a lot once more.
Yeah, not all the extended family, but for sure, and then a happy holidays to all of you, and thank you so much for the invitation. Looking forward to working with you soon, any of you.
Exactly.
Okay, for sure. Bye-bye. Thanks a lot, Raul.
Thank you. Bye.